So it's hello markets this Wednesday morning, and what do we have? We have a near perfect market breadth, near perfect. I would have hoped for something like 1200, but yeah, this is also good. 1:5 advance versus decline. Nifty is recouping some of its losses that registered yesterday. The breadth of the market for the small cap index and the mid cap index is also decent. Let's address some newsmakers here. Not too many newsmakers, but the small numbers which are important. One is Apollo Tyres. Second, to some extent, I think is IndusInd Bank, which has settled now. Third is Lupin, where numbers came after the bell, which are not bad at all. I mean, for the first time after many quarters, so many years, Lupin has got a thumbs up post numbers, but not in terms of stock, in terms of brokerage. The stock ran up from 600 to 740. You got L&T today, and then you got DRL today, and then Zomato, where BofA has come out with a report saying that the ONDC impact is too early to dismiss or assume that the food delivery business is going to completely reverse. But Zomato is bouncing back. So it's a good start, a promising start, if I may say so. Let's see if we can build on it.
SCI as well came out with its numbers. The EBITDA has come in higher by over 42%. Margins also have seen a very big expansion, 5% higher for SCI. That's a very good start there. Nazara Tech, they've managed to achieve their FY23 revenue guidance. Margins have expanded about 500 basis points, but you're not seeing a meaningful reaction come in there. They're also Reddy. The losses have contracted there now to about 14.5 crore rupees. Revenues are higher by about 18%. Reddy 1.25% higher on that particular stock price. There's also KSB, there's Nuvoco Vistas. These are all earnings reactions and positive ones at that. There's SRF as well, by the way, which has increased their capex for setting up of an arm, SRF Alltech, to about 530 odd crore rupees from the earlier 425 capex that they had outlaid. In the meantime, you've also got some negative earnings reactions. Godrej Agrovet, for instance, the EBITDA is down 56%. Let's see what the stock price reaction here is. 4% lower for this one. Castrol as well. The margins have contracted nearly 300 basis points. Stock down 2% as we speak right now. There's Latent View, there's Hudson Agro, and then of course there's Rain Industries as well, wherein the margins have fallen nearly about 600 basis points on a year-on-year basis. So all these are seeing some negative earnings reactions. But the buoyancy for MGL, IGL, let's see whether that continues today as well. These were very big movers yesterday. They've taken a bit of a pause today, at least MGL, which shot up 7.5% in trade yesterday. Tata Com, Birlasoft, of course, was an earnings reaction yesterday, shot up 7%. Let's see whether there's any follow-through coming in there. Sure enough, mild one at that. So it's a mild start, mild earnings reactions, 18,300 here on the index. Kunal, what's next and what trades are you punching in right now?
I think it's a good start for the index given the market trajectory yesterday. Few of the stocks which have been something which have been trading recently, Glenmark, AU Bank, etc. These stocks have opened up quite well. They are amongst the top F&O gainers as of now. But the stock I would look to trade the open would be DV Slab. I think that's a chart which looks extremely attractive. And by the day, the stock has been crossing over some crucial resistances for itself. So that's a stock which would be keen towards trading the opening as well as recommend to clients.
That's DV's Laboratories. That's the first trade that Kunal is punching in. Naresh, what about you?
So that would be Coal India in touching distance of that 240 mark, expecting it to break out in the next few sessions. So that's the buy I'm doing.
Saurabh Mukherjee joins us, and Saurabh, good to have you back. Thank you for joining us. Saurabh, a month ago there was a drought in the market, almost a drought. FIs were selling, nobody wanted to buy India, everybody wanted to go to China, and now looks like there is a feast. DIs are buying, FIs are buying, Saurabh Mukherjee is buying, everybody is buying, nobody wants to sell. What has changed in last 1 month?
I think the blow up of the Western banks and specifically the blow up of American banks has clearly had an impact. So if you see the amount of bond buying that the Fed does somewhere around middle of March, when these the First Republic and SVB etc. started blowing up, the Federal Reserve started buying bonds, and that continues. And once a global investor, a foreign investor, sees that the Fed is now buying bonds, pumping dollars into the market, it becomes relatively easy for them to take a call that the rupee is not going to give up more ground, and thus you have the, as you were mentioning a few minutes ago, Nikunj, thus you have the return of the FII to the Indian market. Whether we like it or not, whether even our clients like it or not, the sorts of stocks people like us buy in Marcellus, the sorts of stocks you guys are flashing up on the screen, are the stocks that FIIs like. So in the last 6 weeks, basically in this financial year, our portfolios up are 8 or 9%. Although earnings compounding stays the same old 20, 25% that it's been this year, last year, the year before that. But the return of the FIIs is largely driven by their realization that the weakness of the rupee or the strength of the dollar is now something that is largely behind us. And thus you're seeing roughly $1 billion a week of FII money coming into our market.
Reading a Morgan Stanley report in the morning, and so the Birlas are convinced that they want to challenge the paint market. The Jindals are convinced that they have opportunity in the paint market. Pidilite is convinced that there's opportunity in the paints market. But you are not convinced, and you still feel that Asian Paints, nobody can challenge it. I mean, I understand it's a sumo. It's been the sumo of the paint market, right? But guess what? There are other sumos who are going to be challenging it now.
So, Nikunj, everybody who plays IPL wants to be Virat Kohli, right? Everybody who plays cricket wants to be Virat Kohli. So I did the maths once. I looked at roughly there are 500 players
it's
in
Dhoni
the
for
IPL,
me.
roughly 100,
Saurabh,
150 are foreigners.
let's get the favorites right. It's Dhoni for me.
So no, what I was saying
Dhoni, we have to agree. I watch for Dhoni, not for Virat Kohli.
Three cricketers, Dhoni, Rohit and Virat take home.
Now you're making a good comeback.
Right, so the Dhoni, Rohit and Virat take home 80% of the prize money and the advertising dollars that Indian cricketers get. I think corporate life is very similar. There are plenty of companies who want to be Asian Paints. That will always be the case. Why shouldn't they aspire to be a 35% ROCE, 20-25% compounding machine? So aspirations are going to be there forever. But in every industry, paints included, we are seeing two players take away 80% of the profits, and the rivals, the aspirants will keep coming. It's incumbent on the sorts of companies you're flashing up on the screen. It's incumbent on them to build their muscle, their fitness, their competitive advantages, and see off the rivals. So using that cricket analogy, I was trying to make the point that the Birlas have valid aspirations. Why shouldn't they? JSW Paints, ditto. Pidilite yesterday announced that they want to do it. But the competitive advantages of Asian Paints in paints, Pidilite in adhesives, Bajaj Finance in NBFC lending are such that it's very, very difficult for rivals to come and have a meaningful impact on these franchises.
Saurabh, I don't know whether this is a recent one or not, but I believe that you've made a large addition, and that's Tata Elxsi to your portfolios. Why is that?
So back in December when we exited Relaxo in our mid-cap portfolio Rising Giants, we bought a Tata Elxsi. So on the theme of dominance, we discuss some dominant franchises in the design of automobiles, in the design of say OTT platforms as front end, in the design of many of the features we see in mobile phones. Tata Elxsi is increasingly emerged as a global leader. And as auto design moves away from the Purana mode, which was once in 10 years, a Toyota gets a refresh or a Honda gets a refresh, as we move away from that into a car design refresh cycle, which is more like what Apple does with its phones, the addressable market for Tata Elxsi, we reckon, has expanded significantly. So it's a dominant player, it's the largest in India in engineering and industrial design services. And its specific depth in designing in the auto sector, in the OTT sector, in the mobile sector, led us to make this a portfolio addition back in January. The stock hasn't done much, I think, for the last couple of years, but if you look at the 20-year track record, the 10-year track record, both in terms of growth, free cash flow generation, it's impeccable. Just a quick disclaimer, all of these stocks that I'm mentioning, I own them, my parents own them through Marcellus, and our 10,000 clients have positions in these stocks.
You wouldn't address that bullish rationale onto the other IT services mainstay companies, would you?
So just to be clear, firms like LTTS and Tata Elxsi, which are in our portfolio, they're more in engineering and industrial design services. This is slightly different from IT services. In IT services, TCS remains our mainstay. in some of our advisory portfolios, we have Infosys. And I think, as I've said over the last couple of years, I remain astonished that people in our country, investors in our country, buy and sell firms like TCS and Infosys on the IT cycle, because to my mind, it's a one-way story. The demand for Indian IT services is unrelenting. The Fortune 500 companies don't really have any other credible place to go to cater to their demands. The migration to cloud is only 1/3 done. So there's a huge growth runway. And TCS, to my mind, is the strongest moat in India on the supply side, right? The main trick in IT services is you need to be able to recruit 1 to 2 lakh people, train them, hold on to them, and monetize them in front of clients. And I don't think TCS does it. I don't think anybody does it better than TCS. I thought the recent results were sparkling. I think a lot of people were disappointed. I loved the recent results. You bring in $10 billion of business in the midst of a Western banking crisis and war in Russia, Ukraine. You give me 25% operating margins. And you give me roughly 16% PAT growth. Those are the sorts of results we at Marcellus like. So TCS remains a big holding in our flagship product.
Much of volatility within IT. If the cloud story and the cloud opportunity is so large, and it could be a multi-year or a decadal opportunity where cloud lakes are getting created, transformation has just about started. Why is that 2 quarters ago IT companies were guiding for something different, and 2 quarters later they are guiding for something different? Why is there so much of cyclicality in a business where there is a linear proposition of growth?
Absolutely. So nice point, Nikunj. I think it's very similar to what we see in say in Indian tech, right? A year ago, had you spoken to Indian tech companies, Indian unicorns, I mean, they were flush with cash. They were spending loads of money on hiring people. If you look at Indian unicorns today, money is tight. They're actually getting rid of people rather than hiring people. So that dynamic also has a bearing on the US tech ecosystem. And a firm like TCS has some exposure to that. But the biggest exposure that TCS will have is US financial services, US banks. And as we know, given the state of the US banking system at the moment, it would be a remarkable American banking CEO who signs a major new contract with TCS, right? So the near-term guidance that TCS is given is rightfully cautious. But if you and I sit here and say 1-year earnings, even 2-year earnings really don't have that much influence on the valuation of a company, it's the next 10 years I'm interested in. It's difficult to see why in the next 10 years, A, the West will not move to the cloud, and B, if it does move to the cloud, it's difficult to see why they won't hire TCS to do that work for them. So it's that ability to in a way, ignore short-term noise and take the long-term view, which creates strong compounding. And I think that's our job, and that's why I thought the Q4 results were both an honest assessment by a credible management team of near-term challenges, but at the same time, the Q4 results were also a clear indication of the sheer muscle that this company possesses and provides to its shareholders.
Projected earnings for FY24 and FY25 are expected to grow in the range of about 13 to 15% depending on the estimate you look at. That may not be the case for IT. IT at best would be, early double digit or 9 or 10%. So does it make sense to buy into IT where the projected earnings could be 8 to 10% when the aggregate earnings will be higher than that?
Right. So I think one way to look at it is to look at free cash flows rather than earnings growth. So in the case of a firm like TCS, as you can imagine, there isn't that much incremental capex required. In fact, there's negligible incremental capex required. This is not Tata Steel or an industrial giant, and therefore the entire PAT that you generate ends up becoming cash flow to shareholders. The biggest shareholder for TCS obviously is Tata Sons, and they end up getting 12,000 crores a year from TCS via the dividend. For shareholders like us, we get a dividend, but we also see the free cash flow generation even in weak years, such as possibly the year ahead. Even in weak years, you're getting 11-12% free cash flow compounding. In good years, you're getting free cash flow compounding pushing 20%. If you take a 20-year view of that, say take 15% free cash flow growth, 16% free cash flow growth over a 20-year cycle, you're getting valuations significantly north of the current valuation. I would venture to say you get a fair value for TCS somewhere double the current share price. So take a realistic estimate of the year ahead, say 11-12% free cash flow growth. Some years, the boom years will be closer to 20. On average, you're looking 15-16%, conservatively 15-16% free cash flow growth over the next 20 years. By the way, they've done much better over the last 20. Over the last 20, they've done 20% free cash flow growth over 20 years. But even if you take a reduced number, 15-16% free cash flow growth over 20 years, this company is significantly undervalued, we reckon.
Saurabh, since we're talking about Rohit Sharma, Virat Kohli and all the cricketers, why don't I add one more? Rahul Dravid, that silent, stable performer. Who do you think, which stocks do you think would really fit that list when it comes to the entire financial space, given what you have in the portfolio?
Yeah, I think, Avan, you know what I'm going to say. I think I'm going to mention a bank whose name starts with H. Bank which, I think after the HDFC Bank, HDFC Limited merger, this will become India's largest PAT generator, largest profit generator. By our estimate, this will generate 8-9% of the nation's PAT. Incredible number, right? Nothing like it has ever been seen before in Indian history. One corporate generating 8-9% of the nation's PAT. Last 4 years, PAT has compounded. In fact, 5 years, PAT would have compounded at 22%. Shares would have compounded at 5%. We love it. I can't tell you how much I love it when things like this happen. It sort of makes our life worthwhile. That you have a compounding machine of this scale, this ferocity, this efficiency operating quietly, humming away, making billions of dollars, and it's available at a steal, and we keep buying some of it every day.
Everybody not buying it. You're making it sound very simple, right? Buy HDFC Bank and go to sleep. I mean, you're making it sound very simple. What you're making it sound simple is very logical also. But if it is so obvious and so logical, then why are there so many naysayers? What are markets worried about?
So Nikhil, let's take HDFC Bank as an example, right? It was listed in 1995. And the story is well known. I'm sure every investor in India knows the HDFC Bank story under Aditya Puri and now under Shashi Jagdishan. If you look at the shareholder register, foreigners own 75% of it, right? And the only reason foreigners don't own 100% is the RBI put a limit on the foreign ownership at 75. Otherwise, foreigners would have owned the entire bank. And I think that remains the big challenge for domestic investors. Their inability to take the long view means that assets like this, companies of this quality, $110, $120 billion of wealth, a compounding machine of enormous strength, ends up in the hands of foreign investors because the domestic investor takes the short-term view, looks at PB multiples and PE multiples, and ends up buying, say, a public sector bank rather than a compounding machine of this strength. And similar story, somewhat similar story with Kotak Bank. In front of you, in front of everybody, in broad daylight, a wealth creation machine has been built, which ends up being majority owned by foreigners because domestic investors tend to be slightly more myopic. They take a short-term view and end up missing out on this. Now, if you want to put it in another format, in a typical 5-year cycle, there'll be 1 to 1.5 years when the foreigner runs away, right? You mentioned it that when we spoke 2 months ago, I remember coming to studios for the budget day, foreign money wasn't there. Even through February, March, foreign money wasn't there. In a 5-year cycle, 1.5 years, 1 to 1.5 years, the foreigner will run away because the rupee will be weak through that period. In that 1.5 years, a gap opens up between earnings compounding and fair value, and that gap is like a laddu, right? We just have to grab that laddu and make the most of it. So this is when Rahul Dravid, to take Avan's hint, this is when Rahul Dravid steps on the accelerator, gets the run rate going, and hits the century or the double century. These are the opportunities that the Indian market provides when the foreigner takes a holiday from India. Stocks like the ones that you're flashing up on the screen end up becoming super attractive.
Okay. So, Saurabh, they say you never say never in the market, but can I say that it will always be never, never, never when it comes to Adani Group of stocks for you?
I think the general point we've made repeatedly over the last 5 years is look at ROCEs, look at free cash flows as a measure of a company's compounding ability, right? So whether it is the companies we invest in or the companies that we don't, the rationale remains the same. Clean accounts, a history of sensible capital allocation resulting in sensible return on capital, 15 ke upar, 15 ke upar return on capital, and dominant franchises, which give you and me visibility on large free cash flows stretching well into the future, stretching 10, 20 years into the future. The result of this mixture that we look for is fair value PEs, which are well north of 100. The stock market typically gives us these stocks at 40, 50 PE. We load up on them, and we load up even more when in years like the the fiscal just ended, when I think our portfolios were down anywhere between 15 to 20%. We buy as much as we can. And then when the foreigner returns, everybody then buys the same stocks, they roll up, and then we go through the same cycle all over again. So clean accounting, good free cash flows, dominant franchises. We keep looking for that. And the good news is India gives us plenty of those at significant discounts to fair value.
Okay. Saurabh, guess what? Dinshaw Arani also joins us, and yeah, he is smiling. Yes. He's smiling because he did not have IT stocks for last 1 year. Saurabh Mukherjee is buying IT stocks for last 1 year. He's also smiling. Dinshaw, what do you have to take to Saurabh Mukherjee? He just gave us a 2-minute, very logical and a very methodical way in which why you should buy into IT.
Oh, no. I won't be buying your IT today. So that's out of the question right now. So we've been calling it out. Nico and Jen, by the way, thank you for having me on your show.
No, answer the Saurabh Mukherjee question. It's a very logical question. It's a very logical premise of Saurabh Mukherjee, and we are not getting into a debate here. I'm just curious to understand what Saurabh is saying. Is very logical. 1/3 of the total cloud opportunity has only been implemented in terms of transformation. These companies are growing. They don't need cash. 8 to 10% growth is going to come back. And that is a decent area to be in.
So exactly. Actually, Nico, the point was that only the valuations which went through the roof for IT guys because of COVID was mainly on the back of the fact that this growth of mid-single digits is going to go into 16, late teens kind of growth, right? And that's why the valuations went on to, for the large caps I'm talking about, is 28, 30 times and forward earnings and stuff like that. Yeah. Now that obviously came to a knot after COVID went away, right? We're not saying that it's a long-term trend that we're looking at, but now look at it this way, that if your growth rates for IT are going to come off from 17, 18 perceived growth rates to your, right now, though, anyway, Infosys announced a mid-single digit, but even if it's late single digits growth rates, what valuation should you give them? You should go back to what they were pre-COVID levels, right? So today also, they're still around 25% premium to the pre-COVID levels. So that's what our concern was. In fact, when we started removing the names, they were at 40-45% premium to pre-COVID levels, right? And today they're at 15. I think some of them, the large caps are at 15, 20 odd percent premiums to the pre-COVID levels, but the growth rates have collapsed. Okay. And that's what we're seeing. So as we said, that in the immediate short term to medium term, probably you will see these IT stocks coming off, maybe not a actual correction in the price, but in terms of time, they will take away. And I don't think our markets are gonna be a flatlining market for next couple of quarters. We believe that in fact, that's what, again, we called out at the beginning of the year itself, that you'll see a bulk of the returns coming in the market in the second half of the year. And that's what we prepared for. So I leave it here.
Okay.
Maybe Saurabh is right. In long term, obviously, everything looks good. In India, frankly, everything in the long term looks very good.
We shall take this conversation forward with both of you. I promise that. But today may just not be the day. Saurabh Mukherjee's got a long day ahead and he's just managed to squeeze in this appointment. So appreciate your time, Saurabh. Thank you for joining us.
Thank you.
But then, Shaw, we are not letting you go. What have you bought last? Simple sawal.
So anyway, Nico, I won't tell you the names. Obviously, we've been loading up on our financial exposure. That's definitely going to be there. And our feel is that in fact, just before I joined in, Saurabh was talking about HDFC Bank. And I actually didn't hear him on the cloud bit. So that's why I was clueless when you asked me that question. So good you briefed me on that. But anyway, he was talking about HDFC Bank. And I think that's one of our favorites. We've been holding it for probably that's the only bank which we've been holding from the day we started our fund, which is Helios Fund in 2005 itself. And we've been, adding to it whenever. And I sincerely believe that this is the one which is going to lead the rally going forward for the banking sector per se. And then, frankly, it's just, there'll be a bit of hiccups in between because recently that MSCI came up with the new rule that they're going to apply a factor of 0.5 to it rather than 1 going forward. And so that's why there's some correction with it. But that's one sector that we very gung-ho on. Another sector that we've been fairly comfortable with has been in the consumer space, which is mainly the discretionary consumer space. And again, we're talking about here, which is aspirational discretionary as such. And here again, we did see valuations bloat up a lot at the beginning of the year. Everybody was fairly gung-ho, and we did chop off or pair off a bit of a position. In the sense, we reduced our weights in these stocks because we saw the P's really bloating up and not getting justified on future growth. And as soon as the stocks came off, we've been adding to those names also. I think going forward, that's another one which is going to be leading the pack. Apart from that, I don't think we added any new names as such. And frankly, I mean, because before you ask me that question again about multi-baggers, you never know, right? I mean, when we bought say a Varun Beverages, which was probably a pure soft drinks manufacturer, I mean, franchisee for Pepsi, we didn't realize that it's going to give a return of 70-80% every year, right? So that's what happened with that stock. And frankly, multi-baggers come along that way.
Dinsha, hi, morning. Curious to know what's the opinion on Mankind Pharma? What a dhamakedar listing. People are still saying it's a buy.
No, I know, Aisha. So our call on Mankind was, in fact, we did analyze it during the IPO time. So it's fairly concentrated. The revenue is fairly concentrated in top 5-10 brands as such. And frankly, I mean, our feel was that giving such a huge premium to the industry wasn't justified, even though if you look at it's purely a domestic play as such. So even if you look at that factor, it didn't justify that kind of premiums as such. And we stayed away, and we were quite surprised that actually we were not too surprised at the time of the IPO, because obviously the retail didn't like it, HNIs didn't like it. It was the QIB book which built up substantially as such, and that's what pulled the IPO. But the fact was that we were quite surprised at the way the premium shot up at the time of listing. So anyway, we're not in that stock at all. So just leave it here.
So you're skipping it right now because the valuations are rich, or are you going to skip it altogether?
No, obviously the valuations were rich at the time of IPO itself. So obviously the listing has seen it becoming richer. So we'd rather wait it out and look at valuations coming in sync. In fact, that's a call we took during the time of Zomato also. In fact, by the way, this was the stock which has done given a heavy premium to its IPO price and was the second largest after Zomato. That's how I'm talking about Zomato. So we took that call on Zomato also on the day of listing. We sold it off and then stayed away from it for till the time the stock came back to around 40s and stuff, and that's when we started looking at the stock again. So I think I'm not saying that this will collapse this way, but the fact is that we don't think this kind of premiums will be justified. So.
Yeah, but what do you make of this entire ONDC network? Who will gain, who will lose? I mean, today we are all comparing that, okay, suddenly the burger which is coming from McDonald's on the ONDC network is 30 rupees cheaper. That's end of the food delivery, networks or food delivery players in India. Is it true? What do you think?
So Nikunj, actually, I was over the weekend. By the way, 30 rupees is too less price to excite me to get into getting on the ONDC platform. But I actually ordered from one of the vendors who's on ONDC. By the way, I tried to order it from a pure ONDC player. He didn't have any stores in my vicinity. So in fact, he had one store which was in Bangalore. So that was out. But I went through one of the other players who was on the ONDC network, and he had, so I ordered a burger, right? It was actually 100 rupees cheaper than what I would have ordered from, say, a Swiggy or a Zomato. But let me tell you how that 100 rupees came about, right? There was a 10% discount offered by the provider, the service provider, on the burger itself. Yeah, there was a difference of some 30 odd rupees on the delivery charge of the burger, right? Now that obviously the delivery charge was pathetic. It was like 8 rupees as compared to 35 for a Zomato or the same for a Swiggy. So it's obvious that this kind of subsidy won't last. And plus, I got a 50 rupee coupon from the service provider. So basically, he was subsidizing, the service provider was subsidizing, wasn't the ONDC network. The price of the burger was the same on both. It was just the discounts which worked out. So it's a matter of time before these guys also come back and say, hey, we can't afford this kind of discounts that we're offering. We're just trying to get into this game as such, and that's what's working out here. So I think it's a matter of time. And frankly, I mean, my experience of delivery also wasn't that great. It came through a Dunzo, the delivery, though the gentleman on the ONDC network was not done so, and it came some 50 minutes later, so it was like a pretty cold burger, while the one which I ordered on Zomato came in like 20 minutes or such. So it was fairly warmer than that. So I did my research, and I don't think it's got a long way to go. It's got a long way to go, and till then, obviously, I mean, if you see globally also, there's only two players who really make it big in the hyperlocal space as such. And the way Zomato is going is he's in fact gaining market share on Swiggy. So I don't know how this is going to work out, but I don't think in the immediate term we've got to worry about the ONDC right now. So
What are you ordering burger? I mean, the most sold thing on food delivery is actually biryani.
Biryani,
Yeah. Then sure, you ordered the wrong thing.
You're asking
Biryani.
the urban consumer, Nikunj, and then you expect biryani as an answer.
No, it's the
I
most.
wanted to make it light on my pocket.
Dinshaw is the urban consumer who buys Metro and all these
HNI, Louis Vuitton, and
Westlife.
Yeah.
Metro is like downgrade for him.
almost
Sorry,
FII.
Dinshaw. sorry, Dinshaw. Aisha, in a sense, was not being frank about the brand affordability and the brand preference of it. Never Metro, it will be Louis Vuitton.
I
it will
just
be Gucci.
stopped short of that.
But Dinshaw, speaking of that entire theme, that consumption theme, what exactly would be the outlook? Is there anything that stood out maybe in terms of the kind of earnings, the commentary that we saw from the likes of Dabur, HUL, Nestle, etc.?
So, Aman, the point is that these guys, mainly FMCG guys, it's coming out to be a mixed picture as such, because some of them are saying that rural seems like picking up, the others are quite confused about it. But our feel is that the ones with a higher network in the rural space may be getting a slight advance indicator about the fact that El Nino is paying pretty traunt as such, and that's why the feel is that there's been a pullback, not a pullback, rather it's a halt on rural demand right now as such. It's not picking up as much as was expected to be at the beginning of this year. So that's the feel here. But frankly, I mean, on the FMCG space, we're not that excited because we don't believe these kind of valuations can be justified for a single digit or probably a low double digit kind of growth that one will see in this going forward as such. And frankly, if your call is on India, is that our GDP is going to pick up and per capita are going to pick up, it's not going to be the FMCG space which will earn. It is going to be the discretionary space and obviously the finance space which is going to earn. So that's where our more concentration is rather than on this space. Probably QSRs will benefit because they've got a very nascent market and they're still trying to penetrate. One saw the results of Westlife rather, and realized that things are really picking up in that space. They've still not been, because of, even despite the urban slowdown that one is talking about, one hasn't seen it in that space as such.
Dinshaw, you mentioned last time and today also that you expect returns to be in the second half. Guess what? Returns have already come in the month of April and May. So do you think the expected returns of second half have already come in first half, or second half will be even better?
So if you see the year-to-date returns, they're not much, right? I mean, obviously April was pretty good. May has been fairly okay till now. But the fact is that if you're talking about, so basically if you go back in history and last 25 years, India has given a return of some 14% annually as such. So if you're looking at that kind of return, obviously you're talking about, when I say back-ended, if you look at that annual kind of return, you're talking about a massive return in the second half. So if we just touch the tip of the iceberg, I believe, even in terms of year-to-date returns. But our call has been also the fact that we've been underperforming the region and the global markets for no reason at all. Our call was that at least this underperformance should turn into outperformance the way one saw in 22 as such. And I think that's what's reversal has happened. FIs have come back in. They've realized that India cannot be clubbed with Asia or emerging markets, and probably you have to look at it separately. And I think that's where the additional flow is coming to India as such. And that's what's helping us out. So our feel is still the same, that we will start outperforming the region. And for India to at least start moving up the chain, things have to stabilize globally, which is looking to be so as such. Even in the US, where there's been so much of upheaval, things are looking a bit more stable now.
Dinshaw, what is the best way to your mind for next 3-4 years? One should simply bet on consumption. I mean, gone are those days where if you wanted to bet on consumption, you bought HUL and Nestle and Britannia. It really has to be different. For example, you bought Campus, you bought Maneuver. What else for next 3-5 years?
So that's the space actually, Nikunj, because I think it's going to be more aspirational spend. So when you get into when your purse becomes larger, right? I mean, mid-income person, his purse become larger. He won't be looking at taking a bath 3 times a day or brushing his teeth twice a day or thrice a day or something. So it's obvious that FMCG will be not that much impacted by these higher purse spends as such. So you have to look at the discretionary space, right? And within that also you've got to look at a space which is an addressable space. So though the consumption base in India is 1.4 billion, but we all know that actually it's 300, 350 odd million, which are really going to make an impact on the discretionary space. So you've got to target that space as such. And that's what we're looking at. And that's what forever we're looking out for ideas within that space per se, which can appeal to this 300 to 350 million odd people who are going to be. And obviously the young population that India is going to be. In fact, recently the World Bank report showed some 200 plus million young people, which is going to be there in India. You can imagine a whole of Europe in one place, young Europe in one place as such. So that's the kind of spends that we're targeting as such. So.
All right, Dinshaw, from Zomato to ONDC to even heavyweights in the tech space, you've really covered it all. So thank you, as always, for being candid and joining us on the show. All right, time for a very quick break. Holding out at 18,250 on the index. Be right back.
Back with first trades right here in ET now. Let's see where the first trades have settled in at. It was sure a quiet start and continues to be quiet and a little bit tempered. 30 odd points in the red is where we're currently at. You've got a UPL, you've got SBI ahead of its numbers tomorrow, Tata Steel, Bajaj Finance, DRL ahead of its numbers, and even L&T is flat with a negative bias ahead of its numbers later today. Z, Pidilite, IndusInd Bank, Glenmark and Petronet LNG, they continue to hold up, however. But let's talk about one of the biggest players in the solar panel manufacturing in the country. He's pretty confident that India will remain a manufacturing hub for years to come, especially since the world looks for alternate supply sources besides China. In the latest edition of CEO at Work, Nikunj caught up with Warrior Energy's CMD Hitesh Doshi at their plant in Vapi.
I'm going to just tell our viewers that Wari is indeed a hidden gem in the manufacturing space. Many may not know, but this is one of the biggest exporter of the solar panel in the world now. And when you're competing at a world level, I guess it is all about efficiency and all about really keeping the supply chain and benefits in place. Now, India does not enjoy a great reputation in terms of executing large projects. So how have you achieved to beat China? How have you managed to keep the supply chain intact?
So we came into the business for the European market. In 2007, 2008, when we decided to come in solar, there was no Indian market. So the culture we built in the factory for the quality, delivery on time, certification, approvals, we always has focused as Europe as a market. So for us, that was not a problem of the reputation or whether we will be able to meet their commitments or not. We have been from the day one there.
Has your business changed completely in terms of a 180-degree move post-COVID because of geopolitical factors, China one policy, and the way things are moving on the supply chain front?
Of course, first thing, COVID plus the energy crisis, Ukraine war, has started thinking about a lot more on alternative energy than the earlier before. The second thing, during the COVID, the world has started discussing about the deglobalization, or I will say the alternative supply chain. So that has helped the Wari. Since the reputation was built for a 15 years, we came in solar in 2008. So we took almost long time to build that reputation, and solar has a lot of entry barriers. in terms of certifications, approvals. So we could achieve all that well in time. Bankability, insurance, so many things. Wari could do that on time. And when this thing has opened up post-COVID, we
So what
are
was
at the
your
right
order
place.
book pre-COVID? It was 10,000 crore, it has become 50,000 crores, right?
Right.
So
right.
in less than 3 years, your order book has gone from 10,000 to 50,000.
Right.
ऐसा क्या हो गया? ऐसा क्या change हो गया?
Okay, Wari ने बहुत कुछ किया, but I will not touch that.
हाँ.
But I will say that globally the awareness for the solar energy has gone up. Number one, energy prices has increased. Number three was that due to the certain challenges faced by the customers during the COVID time, they decided to have the more suppliers. And of course, the Wari was their choice.
So are you adding more business from the existing customers or new customers have come?
Both. Existing customers are also growing. For example, we say that in 2011-12, they were talking about kilowatt. Our customers moved to the megawatt and gigawatt.
So what is this plant? I can see that a solar panel is getting manufactured here, right?
Right.
तो जो घर पे हम लगा देखते हैं, बिल्डिंगों पे लगा देते हैं, this is the solar panel you are making here.
Absolutely.
So one solar panel will generate how much electricity?
This is a 550 watt panel.
Okay.
Typically, when you put a 1 kilowatt system, you get the 4 units.
Okay.
So घर में हम कहते हैं बिजली का बिल कितना आ रहा है. So typically 2 or 3 bedroom house, if they put a 3 kilowatt, that is a 6 panels like this, it's more than enough for their electricity
6
requirement.
पैनल ऐसे लगा दो घर का इलेक्ट्रिसिटी बिल इज टेकन केयर ऑफ.
Absolutely.
एसी लगाएंगे तो
AC आ गया इसमें.
AC
3
आ गया
kilowatt.
इसमें.
जी जी जी.
Okay. The entire industry right now has an import dependence also.
Right.
Right. Your import dependence is still 40%.
जी.
You're trying to bring it down.
जी.
In import dependence, you are still dependent on China. So one side you're competing with China, and second side you're importing from China.
Right.
How is the equation working?
एक जर्नी होती है इंडस्ट्रीज को एक पूरा 100% इंडिजनाइज करने की. फॉर एग्जांपल आज हमें सोलर सेल लगते हैं, इंगॉट लगेगी, पॉलीसिलिकॉन लगेगा. सिमिलरली हमें ग्लास चाहिए, ईवीए चाहिए, बैकशीट चाहिए, ये सारे मशीन्स आप देख रहे हैं, ये चाहिए. तो इसका एक टाइम होता है और वो टाइम धीरे धीरे शुरू हो गया है. फॉर एग्जांपल आज इंडिया में ईवीए बनना शुरू हो गया, ग्लास की फैक्ट्रियाँ लग रही है, सोलर सेल, वेफर, इंगॉट की फैक्ट्री हम लोग लगा रहे हैं. तो ये 2 या 3 साल की जर्नी होती है. तो डेफिनेटली मेरा ये मानना है कि अगले 2 से 3 साल में इंडिया विल बी एब्सोल्युटली इंडिपेंडेंट इन मैन्युफैक्चरिंग सोलर मॉड्यूल फ्रॉम द सैंड.
So you can actually make from sand to the solar module.
Solar module.
आप बना पाओगे.
एब्सोल्युटली.
So where are you right now?
एट प्रेजेंट हम लोग आज की तारीख में सेल से मॉड्यूल पे है. अगले 6 महीने में हम लोग सेल बनाना शुरू कर देंगे. सेल के बाद हम लोग वेफर, इंगॉट में जाएंगे और उसके बाद पॉलीसिलिकॉन और मेटालिक सिलिकॉन में जाएंगे.
You currently have a capacity of 9 gigawatts.
राइट.
You will expand it. You will do backward integration.
जी.
So with 9 gigawatt, what is your turnover? And if it goes to 18 gigawatts soon, what
Yeah.
will be your turnover?
पहले टर्नओवर क्या है मैं आपको बता देता हूँ. First of all, the present capacity is 9 gigawatt and it is going to be the 12 gigawatt in coming months because it is getting
FY24.
no, in next 2 months maximum because machines are already in,
Okay.
they are getting installed. So absolute अगर मॉड्यूल की प्राइस अगर हम बात करते हैं तो मॉड्यूल अगर 2.5 करोड़ रुपया पर मेगावाट है तो 9 गीगावाट अगर फुल कैपेसिटी यूटिलाइज होती है तो 9 गीगावाट पे भी वो टर्नओवर का नंबर 9,000 मल्टीप्लाई बाय 2.5 करोड़ होता है. बट इनफैक्ट वो टर्नओवर नहीं है क्योंकि कैपेसिटी यूटिलाइजेशन आज हम पूरा नहीं कर पा रहे.
Okay.
तो उस हिसाब से जब 20,000 मेगावाट पे हम लोग एंड ऑफ द ईयर पहुंच जाएंगे तो पोटेंशियल कंपनी के लिए अगर मॉड्यूल के प्राइस नीचे भी जाते हैं और 2 करोड़ रुपए का भी पर मेगावाट मॉड्यूल होता है तो पोटेंशियल वहाँ 40,000 करोड़ का खुल जाता है.
Mr. Doshi, if I look at the basic components which are required to make a solar panel, and I think just explain to us what is happening here, then I will talk about it. What are we doing here, sir?
So this is a stage where we are doing the back sheet.
Okay.
On that line, we are making a glass-to-glass module,
Okay.
which is a bifacial,
Okay.
where we need to generate the power from both the side of the glass.
Okay.
So that line is producing a glass-to-glass. This line is producing glass-to-back sheet.
Okay.
Because certain applications, they don't want to generate the power from the back sheet. So there is a back sheet. This is a solar cell,
Okay.
EVA
And this will
and the
then
glass.
eventually this is the one where the solar panel comes from.
And now this is the final solar panel is going
Okay.
to be made.
Now there is a cost of steel, there is a cost of paper, there is a cost of plastic. You were selling it for 25 rupees, you're selling it 250 rupees, has become 25 rupees.
Right, right.
But beyond the point, the cost of plastic, paper, transportation will not come down.
No, it has increased.
It has increased. So then how will you keep up with the basic requirement which is there?
Okay. Let us say this is a 2 meter by 1 meter panel or any panel we are saying. 15 years back, in 2 meter by 1 meter, we were producing a 270 watt. Today we are producing a 550 watt. So eventually it became a double.
Because on the same panel you
So
are
you are using the
increasing
same size of the glass, same size of the aluminum, but the output has doubled.
So I'm going to explain it to our viewers with a simple example of storage capacity. What we were paying for a 1 GB storage capacity versus what we are paying right now. The capacity
you have picked up
has
the right
increased,
point. Yeah, yeah.
and it is only technology which is enabling it. So
Absolutely.
fantastic point.
Yeah.
You don't have debt on your balance sheet.
Not yet.
Why is that? And why are you planning to go public if you don't need cash? If you don't have that, that means you don't need cash. But you're going public.
Yeah, our expansion plans, if you look, now we are planning to invest around 8,000 crore additionally.
Okay.
This complex which you have visited today, this one complex, we have the 4 facilities nearby. We are investing here 3,500 crores. The new complex which we are building up, there we are investing 8,000 crore. And definitely at that level, we need equity and debt.
Okay.
So that to meet that equity requirement, we are going for the pre-IPO round as well as the IPO also.
You've done one pre-IPO round already.
Absolutely.
Okay. So when are you planning to take it public?
Public, most probably by end of this year, we should be in a public. Or maybe by January, let us.
What I also want to understand from you that this industry right now does need a lot of, it needs a stable policy framework.
Right.
US government right now is perhaps giving a lot of initiative for incentive for non-China solar panel manufacturers, whereas you're benefiting because of that. But there is an election cycle next.
Right.
Would that be the biggest risk?
Look, fortunately, particularly in the United States market, they look far ahead. So a lot of new orders which we are getting there for 2025, 2026. That's the one thing. The second thing, we have seen the change of the government when we have been in US market for 10 years. None of the government has gone against the solar. So that is very clear thing. Even if the regime change, solar is going to continue. The way the energy prices are going up across the globe, today the solar is the cheapest and nobody can afford to neglect the solar. So I personally don't see that there will be any change in the coming days.
You are ultimately, sir, a B2B company.
Right.
And this is a very competitive space, which is that while you're talking about pricing coming down, efficiency kicking in a competitive environment, especially when you have a global bidding, I'm sure your buyers and OEMs would also be capable, would be understanding the way how the cycle is moving. So what happens to your margins? Even though you will add capacity, you think your margins are unlikely to expand?
See, first thing is our customer wants us to be sustainable and give them the service for 25 years. So the product they are buying for the 25 years, they are not buying for day or two.
A lot of corporate houses in India, generally, Reliance, they've already said that they want to perhaps now venture in this entire solar manufacturing space.
Right.
Are you worried, or you think that that is not a competitive threat?
No, I think the overall market size is growing very fast. For example, we are speaking about last year, globally we have done 220 gigawatt installation. By 2030, to meet a minimum goal without the hydrogen story and EV story, we will be reaching to the 1,000 gigawatt. So if the pie is so big, going to be we need a lot of players in this. So it's a good that the Indian companies are coming up and the globally customer wants more suppliers from India.
So you
not only the Indian market.
You don't expect a geo kind of a moment happening in this industry?
No, this is a little bit different industry and different market.
Okay. It's only focused on solar, but you are an energy transition company.
Right.
You are moving into hydrogen. You're moving into battery manufacturing. There are both businesses.
Last 4 years, we are working on the battery. And today, we are producing the lithium ion pack, supplying to the EV resorts, even the first hydrogen plant as with the Wari batteries. Today, more than 40,000 electrical vehicles are running with the Wari batteries.
14,000 electric vehicles in India are running on Wari batteries.
Wari batteries. And this is going to be the increase further. Now we are going into the lithium ion cell production. On a green hydrogen side, we are seeing we'll need a lot of electrolyzers. So these electrolyzers needs to be produced in India. So last 1 year we are working on that. We signed a couple of agreements, and probably next 1 year we will see the Wari is shipping the electrolyzers not only in India but outside India.
How large could be that business for you in 3 years? The non-solar business.
I think it will be equal to the solar.
In 3 years. Okay. Now, whatever you're doing, Hitesh Bhai, technology is the heart of it.
Right.
Whether changing the solar module or investing in lithium and other alternate batteries. What is your R&D cost? And do you think you will be able to take that kind of an R&D cost here?
Today there are more than 250 people are working in our laboratory and our R&D. And cost-wise, for example, 4 years we have invested only on the batteries. We can imagine how it is going. And going forward, this will increase further.
You are making the business sound very simple for me, right? If the business is so simple, how come not everybody is entering in it?
See this, let us understand the buyers. They are buying the product for 25 years. 70% financing is done by the bankers. So bankers wants to be sure whatever the product is purchased, that product is going to work for next 25 years.
Okay.
So it looks very simple, but that product needs that quality, certification, insurance, field test, ground reports for at least 10 to 15 years, how our panels are performing. And there are a lot of third-party reports about the panel's performance year on year. There you need to be in a Bloomberg list. Wari is only the Indian company. For last 7 years, constantly coming on every quarter in a Bloomberg Tier 3 one. Out of the globally 30 companies, right? So hundreds of the things are there, which you need to be there. So it looks simple, but it's not.
So what would you say is the most distinctive feature of Wari?
Customers' trust. Last 15 years, I will say that 90% customers, or maybe 95 plus, customers are the sales. They are not changers.
But what is
And then in India and globally, hundreds of the companies are coming every year to compete us. The customer has kept us constantly. They have grown and Wari has grown.
today to see a roof or a house which has a roof covered with solar panel is not a novelty. It is a reality.
Right.
Every 1 out of every 10 bungalows in India have a rooftop. Chota bada wo baat alag karta hai. What is happening in the retail business?
Retail, first you need a service, number one. Number two is you have to go and tell the customer why they should go for solar. So Wari was not able to do alone. So we created a large franchise network. We created a large training in our another factory in Toom. And that's the reason today we are enjoying 16, based on the year, from 16 to 25% market share in the retail segment.
60.
1/6.
1/6.
1/6 to the 25.
Tata Power is saying that they have big plans for the entire solar
Absolutely.
place.
Yes, they are going in a rooftop market. And if you look to the market after the Tata Power today, you will find the Wari name there.
So in simple terms, if you have to explain to our viewers, because everybody wants to reduce the electricity bills, everybody understands the need of making India
Right.
more energy sufficient. So what is the maths of putting a chat ke upar solar power?
The first thing is the green energy.
Okay.
The second thing is a payback depends on the area you are.
Okay.
It is between 2 years to maximum 5 years.
Okay.
If some states are giving very low cost power to the household, there may you go for the 5 years. Then there are the tax benefits. The government is offering accelerated depreciation of the 80%.
So 3 benefits hain abhi.
And the last thing is that once you pay back, is done, then solar panel life, we give the 25 years warranty, but the panels works for 40 years more. So then you have absolutely free power.
Okay, what an interesting chat coming in from the top boss at Awari. In the meantime, let's just take stock of what the market as well is up to right now. We've stabilized. It is a quiet start and continues to be quiet. So haven't seen any meaningful move as such on the index. We're around that 18,200 print. Pressure on Aarti Industries, on a PNB, on Apollo Tyres, irrespective of a great set of earnings, seeing some profit taking there. Even IGL is unable to see a follow through after a big move on the stock yesterday, and Rain is down 2.5% reacting to its numbers. But talking about earnings, let's talk about Chalet Hotels. That's been a buoyant sector. Their profit has climbed in the Q4. So let's try and understand whether the steady rentals from commercial portfolio are going to come in and whether healthy hospitality revenue is going to sustain. We have with us Sanjay Sethi, MD and CEO at Chalet, joining in on the show right now. Sanjay, great to have you on ET Now once again, and congratulations. A stellar quarter. Wasn't expecting anything different as well, but strong growth. Having said that, your PAT did get impacted by a one-off charge of about 18.5 crores or so. Could you tell us what exactly is this one-off? Sanjay, you'll have to unmute your audio.
Apologies for that, and good morning, Aisha. There was this one-off write-off that we had to take on our residential project on account of some historical costs associated with that. So we've taken that and closed that matter with this year. But we've done extremely well. If you really look at the quarter or the year that's gone by, quarter we are now about 2.3x of last year, similar quarter. Our revenues are up 17% sequentially, and our EBITDA is up 36% sequentially in the hospitality division. On a consolidated basis, our EBITDA is also up 34% sequentially and 4.3 times last year, same quarter. The important thing is that the revenues have not only held up, they've grown aggressively between quarter 3 and quarter 4. Our costs have held, and thereby the EBITDA margins have improved significantly at Chalet Hotels. We've actually been able to report 46.4% EBITDA margin on a consolidated basis, whereas the hospitality part of the business recorded 47.6% EBITDA margin, which is extremely healthy by any benchmark. We've also managed to close the year at a healthy 500 crore EBITDA, with a margin of 43%. Our profit before income tax is 272 crores, and the total comprehensive income is 185 crores and change for the financial year. All in all, an excellent quarter. I think it's driven by few events that have also happened, which have taken very positive shape for Chalet and which will bear fruit in the coming years. For example, we signed our first hotel in Delhi, which is under construction now. It's a 400-room hotel. That's going to be a big win for us. We've also forayed into the leisure segment with the acquisition of the Duke's Retreat at Lonavala. In addition to that, we made very strong inroads on our sustainability goals. We've got roughly 1,200 crores of capex spent on projects that are coming into play in the near future, throwing up more than 20% EBITDA margin. So clearly looking very strong. It's been a great year and looking very strong here onwards.
Right, looking very strong going down the line. Just wanted to understand what the outlook is in terms of the commercial pipeline as well. Are you seeing steady rentals for the commercial portfolio? Are you seeing that the share of the rental income as well is likely to go up?
So, Abhi, yes. You see, we've got almost 1.7 odd million square foot of office space between Bengaluru and Mumbai coming into play in the next few months. Bengaluru's rental in the market is around 62 rupees. Mumbai is around the 125 rupee mark. So clearly, there's a huge upside again to gain from the office assets that we're developing. And we've got almost about 1,100 rooms under development on the hotel side. Overall, I think office business is a hedge for the cyclicality of the hospitality industry. So from that perspective, that's a great hedge and diversification that we have. But we are primarily a hotel company. And on the hotel side, our growth is very, very exciting right now going forward.
Sanjay, morning. Nikunj also joining in. Now, what perhaps everybody wants to understand from your vantage standpoint, do you see this cycle which is there in the entire sector, whether it is Chalet or whether it is Indian Hotels or whether it is any other hotel chain? Is this a multi-year cycle where prices will be strong, supply will be less and demand will be more? This could be a 2-3 year phenomenon?
Hi, Nikunj. Yes, I strongly believe that. And my gray hair, like you mentioned last time, is not a proof of anything else. Look, we're blessed with a situation where the demand continues to be in double digit for the industry. And this is, of course, different for different markets within the country, but pan-India, that's the sort of growth that you're witnessing, especially in the tier 1 cities. Supply side is extremely muted at about 4.5% to 5% for the next 4 to 5 years. So that combination gives us a great run for the next 4 to 5 years, which is the foreseeable future. It's very difficult to predict beyond that, but the next 4 to 5 years look extremely healthy.
Do you think next 4 to 5 years they look healthy? Because ultimately, the hotel industry is a cyclical industry. We don't know what will happen next month, right? That kind of world we live in. You are giving me prediction for 4 to 5 years. I mean, the shareholders will be happy to hear it, but there has to be some thought behind it, right? So I'm curious.
Nikunj, let me caveat that. Listen, leaving aside an event like the pandemic or something like that, we are pretty good on a year-on-year rise for the next 4 to 5 years. And this is this logic is a very sound logic based on the demand and supply situation. India's story seems to be strong. We do expect a lot of travel coming into India, both leisure and business, especially business going forward. G20 is just one event that's happening this year, but the repercussion or the benefit of G20 is going to be enhanced business engagement between various countries, and that's going to lead to a lot more business travel. India domestic business travel is very robust. It's growing very aggressively. It isn't pent-up demand. Unlike a lot of people who believe that initially it was pent-up demand, that's not the case. We are now in the 10th month or 11th month of month-on-month growth. So yeah, I'm very confident of this 4 to 5 years.
One is demand. Second is the ARR. Do you expect that the growth in the ARR would be in sync with what the normal GDP is, which is that if there is a normal GDP growth of about 10-11% or 12 to 13%, ARR will be in line with the nominal GDP growth?
Well, I expect ARRs to be in the 8 to 12% range for the next 1 or 2 years. In fact, maybe even slightly higher. And at that point, after that point of time, I expect them to stabilize at that 8 to 9%. And that's where I see that holding. This is again driven by the fact that the demand continues to outpace supply. And in that situation, the rates, especially in the big cities, are going to rise, especially Mondays to Fridays. And that's going to drive the business. We've had a very high acceptance of the 30-odd% or 25-30% increases that we've done at the corporate contract front this year. There was no resistance at all. All everyone wanted was guarantee of rooms.
Now, the acquisitions that you've recently undertaken have been via your internal accruals. The Duke's Retreat, for instance, that is part of expanding into the leisure portfolio. Are there any more acquisitions in the pipeline, and will all of this be funded via your internal accruals?
Savannah, as I said earlier, we've got about 1,100 rooms already under development. So a lot of the future capex is going in there. But the internal accruals are aggressive, and I think this will give us headroom for more acquisitions in times to come. We must also keep in mind that our debt profile is going to fall very rapidly from next year onwards. Two things are going to happen on the debt. 2,400 crores of debt today, 1,200 crores is for office assets, which are getting deployed as we speak. And that's going to create its own EBITDA to support that part of the debt. Also, the debt of 1,200 crores will move to LRD, which is lease rental discounting, which means the cost of capital will come down there. All of that combined together is going to create headroom for further growth beyond the 1,100 rooms or beyond the 2.5 million square foot of office space that we're speaking about. And as and when that happens, if the opportunities are right, we'll be very keen to look at them.
So Sanjay, really good to have you back. And yes, now I realize that grey hair sometimes is stress, but in your case, I think it is happiness and it is wisdom.
Silver lining, Nikunj.
Good to have you on ET Now. Thank you so much. For a packed show, Saurav Mukherjee saying why he's buying IT, Dinshaw saying why he's not buying IT, Hitesh Joshi of RA telling us that our solar prices actually, I mean, just think about it, 15 rupees 5 years ago has come to 2.5 rupees, and he's telling us that it will come down by 80% in another 5 years. Which means that we could be in a decade where solar power in India actually could be free.
Yeah, absolutely.
So that's the world.
And especially the kind of demand that he was talking about as well. And yeah, you know, like you rightly said, the kind of cost efficiency which is going to come in.
You know, it's like what's happening in the solar industry is actually like what has happened to the storage industry. I remember I used to buy a 1 GB pen drive for about 400 rupees. Today, Apple or a cloud service gives you 1 TGB of cloud at about 55 rupees a month. So 1 GB is become 1 TGB, which is 1,000 times more, and price has come down by 90%. So if you put that ratio analysis, I think that is what is happening to some of the solar power and some of the wind energy producers now.
Oh yeah, absolutely. We'll get you a slice of that conversation once again, but after this quick break.